Superintendent Neiman.
Thank you. A major aspect of regulatory reform is streamlining and modernizing our regulatory structure. Your proposal includes merger of the OCC and the OTS, and I support that change. Some, including our nation's largest banks, however, propose going further to create a single monolithic federal bank regulator, which raises, in my opinion, serious concerns. Creating a single regulator as a means of improving financial regulation relies, in my opinion, on the faulty assumption that regulatory consolidation leads to a stronger and safer banking system in itself. In my opinion, the opposite is true. Such a proposal would increase the fragility of the system by increasing industry consolidation, by eliminating needed checks and balances, and subordinating the interests of the consumer to the business goals of a handful of mega banks. In my experience, multiple regulators yield better results for consumers and for financial stability, much like multiple judges are used in the Olympics to arrive at the right score. What are your concerns about the proposals to create a single monolithic regulator? And how important was it for you in drafting your proposals that the FDIC and the Federal Reserve retain examination authority to better inform their respective missions of deposit insurance and lender of last resort?
Thank you for raising that question, and I think you framed the choices thoughtfully. One of the most important things we decided we had to do was to eliminate the weakest parts of supervision in the system and eliminate the opportunity for people to take advantage of weaker supervision and flip their charter or shift risk to those parts of the system. One of the principal examples of that, unfortunately, was in the difference between the standards applied to thrifts and applied to banks. So we thought eliminating that was a necessary, absolutely essential condition for reform. If you look beyond that, there's less evidence that having the federal banking system we have, with two entities responsible for different types of state chartered banks, alongside a single federal supervisor, would create really meaningful risk of arbitrage in the future. In fact, if you look at the standards applied by bank supervisors, in general, they were more evenly applied and more effectively enforced. So we don't think it was necessary or desirable to try to force all of that into one new entity, partly because of the concerns about concentrated power, and partly because, frankly, we're asking the Congress to do a lot in a very short period of time, and a guiding principle that affected our choices were to say we want to make sure they're focusing on the things that are essential to do, and not on those that might be desirable to some people, but would not offer a benefit that was proportionate to the political difficulty or the practical difficulty of doing it. And further dramatic consolidation of bank supervisors, we didn't think met that test. Well, but, of course, we're open to suggestions, and if there's will in the Congress and interest in going further in terms of consolidation, we would, of course, be happy to be supportive of that. But I think you have to balance the factors that you laid out in your comments.
And you would share my concerns over the role of the checks and balances, and I often use as an example the role of the independent FDIC in raising issues. The importance of the leverage ratio was an important checks and balance in the regulatory scheme.
I think you're right that there is virtue in multiple pairs of eyes looking at these institutions. But on the other hand, competition across regulators creates risks too. We didn't get that balance right. We thought we've proposed how to fix the weakest parts of the problem, greatest opportunities for evasion and arbitrage. But, of course, we'll be open to suggestions about how to get that balance better.
Okay. I yield my time. I'm going to pick it up regulatory reform in the next round.
Thank you.
Assuming we're going to have a next round.
I hope so.
Right.